Good morning, friends. Let's start writing the summary of the earlier one, economic value added. Topic 27, economic value added. Topic 27, economic value added. Question number 1, EVA equal to EBIT into EVA equal to EBIT into 1 minus tax rate. EVA equal to EBIT into 1 minus tax rate. EBIT into 1 minus tax rate minus capital into WACC minus capital into WACC. Capital equal to equity plus reserves plus long term loans. Equity plus reserves plus long term loans. Equity plus reserves plus long term loans. Market value added equal to market value of equity minus book value of equity. Market value of equity minus book value of equity. Market value of equity minus book value of equity. Question number 2. Point number 1. Question number 2, point number 1. EBIT should be first adjusted. EBIT should be first adjusted for the advertisement expenditure. Should be first adjusted for the advertisement expenditure. Next point, capital should be taken on the basis of replacement cost. Capital should be taken on the basis of replacement cost. Should be taken on the basis of replacement cost. Question number 3. EVA is an excess return. EVA is an excess return generated by the company. Excess return generated by the company. Excess return generated by the company which will be enjoyed by the shareholders. Excess return generated by the company which will be enjoyed by the shareholders. Full stop. Hence a company can declare an EVA dividend. Company can declare an EVA dividend without any impact on its value. An EVA dividend without any impact on its value. Without any impact on its value. However, if the company does not declare dividend, the value per share will go up. The value per share will go up to the extent of EVA per share. The value per share will go up to the extent of EVA per share. Will go up to the extent of EVA per share. Question number 4. WACC can be calculated. WACC can be calculated using the below format. WACC can be calculated using the below format. Source, cost, weight, product. Source, cost, weight, product. Using the below format: source, cost, weight and product. Next point, cost of debt should be taken as post-tax cost of debt. Should be taken as post-tax cost of debt. Should be taken as post-tax cost of debt. Next, part E. P ratio cannot be same. P ratio cannot be same for different companies. Cannot be same for different companies in the industry. Cannot be same for different companies in the industry. Same for different companies in the industry. It should be adjusted. Should be adjusted for the leverage. It should be adjusted for the leverage of the companies. It should be adjusted for the leverage of the company. Next point, a company having higher leverage. A company having higher leverage is more risky and will command a lower multiple. And vice versa. Okay. So we are done with one technique in the last class, which is currency invoicing. I'll give the summary notes later on for that. Now we'll move to the next topic, which is leading and lagging. I'll first explain the concept and then we start solving problems on it. Just a minute. Okay, now coming to leading and lagging, there can be multiple scenarios in leading and lagging, but I'll just explain the crux of it. What do you do in leading and lagging? First, let's assume a scenario that there is a receivable. I have to receive some $10 lakh from my, let's take payable first. Payable is easy to understand. I have $10 lakh to be paid. Now what leading and lagging says is that we should do an analysis whether to lead the payment or lag the payment. Now certainty of forex risk will always be there. Certainty will always be there because you will take a forward contract. Practically forward contract is one way of ensuring that you pay XX amount. Now this 10 lakh payable, 10 lakh USD. If I want, I can pay it today or after 3 months. My supplier has given me a 3-month credit. This 3-month credit can at times be free credit or at times can be an interest rate also charged on it. But the benefit is US interest rate will be 1%, 2%, whereas India's interest rate is going to be 10%, 12%. So he may say that you take 10 lakh US dollars, but you have to pay me after 3 months, and the interest rate which I am going to charge you is 2%. That's what he agrees on, then closes it. Now, if I want, I can pay today. How do I pay? 10 lakh into 65, because 65 is today's price, plus 12% interest, because I was to pay only after 3 months. I was to pay after 3 months. Today I pay it fine, but for 3 months I have to pay interest now, because if I am comparing both the option, I'll have to compare what is the overall outflow after 3 months. Today's payment can't be compared with the payment which is being made after 3 months. So what will happen is 12% interest for 3 months have to be paid. This is one option. You don't agree to this, then here what will happen is 10 lakh plus 2% interest. 10 lakh plus 2% interest, but the multiplier can be 66. Why 66? Because in 3 months the dollar will appreciate to 66. So you can either lead the payment or lag the payment depending on only one concept: lower outflow of INR, higher inflow of INR. But you cannot compare day 0 payment with the day 90 payment. What you can compare is only day 90 vis-a-vis a day 90 payment. You cannot go ahead and compare today's payment with the 3 months later on payment. So to make it comparable, what you will do is you will see 10 lakh into 65 plus 12% interest vis-a-vis 10 lakh plus 2%, but the amount you multiply is going to be 66. Why this difference is? US interest rates are lower, USD is going to appreciate. US interest rates are lower, USD is going to appreciate. Now, today's price, I am just giving you imaginary numbers. I am giving you imaginary numbers saying that today's price is 65. After 3 months, the forward contract price, it's not speculating. I'm not speculating in both the calculation I can do today and then finally decide what is going to happen. This is also certain. This is also certain. When will it become uncertain? If you don't take a forward contract. If you are not taking a forward contract, it's uncertain. I am saying with certainty, it's going to be 10 lakh into 65. With certainty, it is 10 lakh into 2% plus, 10 lakh plus 2% into 66. Both are certain to happen. With certainty, these payments are going to be done. Now, the company can decide this calculation. Clear? Any doubts in this? This is as far as payables is concerned. Now, listen. Any doubts first on this? Now, in payables, there can be multiple scenario. A scenario can be cash surplus, cash deficit. You can either have a cash surplus scenario or a cash deficit scenario. Whatever calculation I did, it's from a point of view called as cash deficit. Why cash deficit? You pay and take a loan because you don't have money. But if you have money in hand, then there is no concept of a interest. But what finance says is that if you are not considering borrowing interest, consider the opportunity cost of an investment interest. What is opportunity cost is? If you had not paid 10 lakh into 65, you would have created an FD, and the FD would have given you 8%. So don't consider 12%, consider 8%. So if there is a surplus, then interest rate is called as alternative investment rate. If there is a deficit, it's called as alternative borrowing rate. But you will have to either consider borrowing rate or investment rate. One of the rate you will have to consider and then proceed ahead. So the basic concept is that you have to pay me 5 lakhs today, $5 lakh. I am going to decide what, I have to pay you $5 lakh today. I have to pay you $5 lakh. You have given me two options. You want to pay it today, pay it. Pay after 3 months, pay it. But if you are paying after 3 months, don't pay me 5 lakh, pay me 5 lakh 5,000. That's what agreed on. Now what I am going to do is 5 lakh into today's exchange rate plus the interest to an Indian bank vis-a-vis 5 lakh 5,000 into the forward contract rate. Whichever is better, I'm going to do it. I'm not bothered about after 3 months interest and all, because that is anyway going to be paid in both the option. Because even if I pay in after 3 months, I'll pay by taking a loan. So I'm not bothered about post 3 months what happens. I'm only bothered about till 3 months what is going to be done. So this is one concept. This is as far as your payables is concerned. Then comes receivables. Receivables also same concept. Collect now, collect later. Collect now and collect later. But here in a practical world, I will not have that much flexibility saying that I cannot force my customer to pay it now. Though as a concept you are going to learn it, but I cannot force my customer saying that you will have to pay me immediately. He will say, I'm not going to pay you immediately. You gave me a credit of 3 months, ask money after 3 months. So questions, if they don't talk about any discount, then it will be like this: 5 lakh into 65 plus interest, or 5 lakh into 66. You cannot charge interest and all to your customer because the terms of the agreement may not agree on it, saying that you can charge an interest and all. So the question will give you reference to all of that. To cut it short, very simple thing: should I pay today or pay it after 90 days? Should I receive today or receive it after 90 days? For both the things, there's only one rule: higher inflow of INR, lower outflow of INR. I need a higher inflow of INR or a lower outflow of INR. I don't see anything else. I need more money to come in, I need less money to go out. Whether to pay today or whether to pay after 90 days, both are fine by doing this analysis. Clear? Any doubts on this? Now the term lead means now, the term lag means payment. Leading a receipt means receiving payment now, and lagging a receipt means receiving a payment later. Leading a payment means making payment now, lagging a payment means making payment later. That's why this term is called as leading and lagging. You need not go through this. These are 8 different scenarios which will come for leading and lagging. I'm going to explain all of this with the problem. So let's not spend time on this. Let's directly go to problems now. Okay, let's look into this. JK Limited has an accepted topic 48, page number, yeah, one. JK Limited has accepted an invoice of 10 lakh yen. Spot rate is 0.50 per yen. 90-day forward rate is 0.52 per yen. Advise JK Limited whether they should avail the full credit or lead the payment if the interest rate in India is 6%, 18%. Will the position change if the company is running a cash surplus? What would be the position if JK Limited had raised rather than accepted an invoice? Okay, now I am an importer. I need to make 10 lakh yen payment. My supplier is giving me a credit of 90 days, free credit of 90 days, but I am deciding whether I make the payment today or I make the payment later. The reason for this confusion for me is the spot rate is 0.50 per yen, the forward rate is 0.52 per yen. Is the yen depreciating or appreciating? Is the yen depreciating or appreciating? Appreciating, and my liability is yen. I wouldn't want my liabilities to appreciate. I wouldn't want my liabilities to appreciate. That's why I'm thinking whether to lead the payment or lag the payment, because liabilities are appreciating. I'm bothered about it. I don't want my liabilities to appreciate. So I'm thinking whether I make the payment today itself by taking a bank loan at the rate of 6% and 18%. Now there are two issues. Today I have a N liability. That N liability is going to appreciate at some rate. We are not going to calculate it, but it's going to appreciate from 0.50 to 0.52. Whether I allow that to happen or convert into an Indian loan and allow that Indian loan to appreciate at the rate of 6 or 18%, because 6 or 18% is the interest I have to pay. Now practically when this scenario comes in, most probably if my supplier is giving a credit of 90 days, if I am making the payment today, I can discuss with him and make a payment of something like 9,95,000 or 9,90,000. That is a practical consideration, because I can tell him that why do you want me to pay the same 10 lakhs, because I am paying it today, why don't you give me some discount. So practically that will happen. Question doesn't have information on it, so let's ignore it. Two answers. We'll have to first do lead payment and lag payment. Lead payment is making payment today. If you make payment today, you'll have to pay interest. If you don't make the payment today, you need not pay interest, but you will have to pay a higher amount because of the currency appreciation. Clear? Any doubts on this? Now write scenario 1 when the interest rate is 6%. Scenario 1 when the interest rate is 6%. Now, in the center of the page, write the liability which is there. Liability equal to 10 lakhs yen. Liability equal to 10 lakhs yen. Two parts. Lead payment, lag payment. Lead payment, lag payment. Lead put arrow mark down, pay today. Pay today. Lag means how much credit? Pay after 90 days. Lead payment, pay today. Lag payment, pay after 90 days. Now when it comes to lead payment, today if I pay 10 lakhs into 0.5 or divided by 0.5. Think about it, don't give an answer in a hurry. Otherwise do your formula and then let me know. You try to do in a hurry, you will make a mistake. I have to convert into INR. Is it into 0.5 or divided by 0.5? Into or divided? It's into 0.5. See, please take care of these aspects. Yen is a cheaper currency than INR. Yen is a cheaper currency than INR. So it's going to be 10 lakhs. Listen for some time. I'll tell you to note it down. Into 0.50 plus interest at 6%. Vis-a-vis what can happen is 10 lakhs into 0.52. This is after 90 days directly, no interest, nothing is being charged. You will pay 10 lakhs into 0.52. You calculate and tell me which is better. Along with interest, what comes out to be better? 10 lakh into 0.50 plus interest at the rate of 6%. You will have to charge interest at the rate of 6%. I'm not, so what is going to happen is, I have to pay you 10 lakhs yen. I pay you today. How do I pay? I go to a bank and ask for a loan. Bank gives me a loan. I have made your payment. You are not bothered about it. Yours and my liability is closed. But bank is asking for interest, so I am paying that interest to bank, not to you. And in the other scenario, you are not asking me any interest. You said 10 lakhs only is needed. You gave me both the option. You want to pay today, pay it. See, you cannot ask me why are you paying today. That's my wish. I can pay it today itself. So I'll pay it today. You will not be bothered about it. So I paid my amount today. What practically can happen is when I pay today, I can ask you for a discount. Rather than paying 10 lakhs, I'll pay you 9 lakh 95 or 9 lakh 90. No information is there in the question, so let's not speculate on the discount part. I've just straight away paid you 10 lakhs. You are not bothered about it. So you get your 10 lakhs today, or you get your 10 lakhs after 90 days. Your liability is closed. The bank is asking me to pay interest, so I'm paying that interest to the bank. Proportionate 90 days. I purposely didn't write it. I wanted you to calculate and then let me know. It has to be for proportionate. If you have done for a year, then correct it with a different pen. Because your comparable number is expected payment after 90 days vis-a-vis expect. When I was explaining theory, I told you that after the period we are not going to consider, because anyway you may have to take a loan for the other option also. The loan may be taken for both the options. Interest at 6% for 3 months. So this is 5 lakh. Okay, done with this. Okay, listen for a minute. Let's be clear on the concept. Now, in a finance, whenever you compare two alternatives, you cannot compare them at different points of time. When I say different points of time, today I pay 5 lakhs to you. After 3 months, I pay 5 lakh 20. Both are not comparable. Today's payment can't be compared with the payment which is to be done after 3 months. Either you bring that 520 to today's value or take 5 lakh to tomorrow's value. Then only both can be compared. That is where that interest has come into picture. Why interest came into picture is to bring both the values. This is day 0 value. The moment you charge interest, this becomes day 90. This is straight away day 90. Why I am not bothered about beyond this period? Maybe you continue to pay interest, but interest will be paid in both the alternatives. In alternative 2 also you will have to pay interest because you will not have adequate money. If for second alternative you have money of 5 lakh 20,000, it means for the first alternative also you will have money of 5 lakh 7,500. If you have money in the second alternative, first alternative also you will have money. If you don't have money in both, you will pay interest in both. So I am not bothered about what is going to happen after 3 months. My worry is only till 3 months. When you pay today, technically you are converting your N liability into an INR liability. Technically you are converting an N liability into an INR liability. N liability to INR liability conversion leads to interest payment of 6%. N liability, when it converted into INR liability, you will have to pay interest at the rate of 6%. 0.50 became 0.52. No, can you tell me appreciation depreciation percentage? Forward rate minus spot rate by spot rate into 12 by M into 100. 0.52 minus 0.50. How much? 16%. 4% is for 3 months into 12 by M. So it's basically 16% for a year. Now, what we were trying to do is whether to pay interest at the rate of 6% or pay an appreciation or allow the liability to appreciate at the rate of 16%. We have agreed on 6%. When you do 18%, you will agree saying that let the liability appreciate at 16%. 16% is the maximum interest I can pay. 16% is the maximum interest I can pay on a loan. Because my liability anyway is going to appreciate at the rate of 16%. Appreciation depreciation percentage, it's going to appreciate at the rate of 16%. Clear? Any doubts on this? Next, do the second one. When interest rate is 18%. When interest rate is 18%, this 18% we will not agree to it because the appreciation is going to be only 16%. This is going to be okay. Now the earlier one we should have answered saying that the basic thing is for that scenario one you should have finally written that the company should make the payment today. The company should make the payment today. For this scenario 2, the company should make the payment after 3 months. The company should make the payment after 3 months. Scenario 1 was the company should make the payment today. Now the company should make the payment after 3 months. Okay, now coming to the second part, will the position change if the company is running a cash surplus? Cash surplus means you have sufficient money available, so there's no concept of interest. So how do we answer this? We have to. So what do you want me to write? Will the position change if the company is running a cash surplus? The answer would broadly remain the same, just that we'll write in the write-up saying that the company should calculate the interest at an alternative investment rate it is assumed that 6 and 18% are alternative investment as well as borrowing rates. They've just mentioned if the interest rates in India are, so my assumption is this is investment rate as well as borrowing rate. Not a logical assumption, but I don't have information. It's not a logical assumption, but the problem is I don't have any information. Ideally, they should have told me 4-6%, which will indicate 4% is deposit, 6% is borrowing. 14/18, 4%, 14 is deposit, 18 is borrowing. If they give that way, I would have done the same calculation again, but here instead of adding 6%, I would have added 4%. Here instead of adding 18%, I would have added 14%, whatever be the scenario. Next, part 2 of the question. If the company is having a cash surplus, then it need not pay interest. Full stop. However, it will lose the opportunity. It will lose the opportunity of investing. And hence we should consider interest lost. We should consider interest lost as an opportunity cost. Next point, interest lost as an opportunity cost. Next point, it is assumed that the above interest rates are alternative investment rate slash borrowing rate. Full stop. Hence the answer would remain same. Third part, what would be the position if JK Limited had raised rather than accepted an invoice? Raised means you are an exporter now, you will be receiving this amount. Now, the issue in this question is, logically I cannot force my customer to pay it today. If I want, I can pay it today, but I cannot force my customer to pay it today. No information is available assuming that option is there. That is, even if I get the money today, I'll get 10 lakhs. Practically not possible, because if I am initiating it, if I tell you that you have to pay me 10 lakhs today, he'll say nothing doing, I'll pay you only 9,80,000, and I may have to agree on it, because if I want the payment today. So we are going to do the same thing again. Two parts is going to be receive payment today, receive payment later. Calculation is going to remain same. 10 lakh into 0.50. After getting that, I'll create a deposit at the rate of 6%. First scenario, deposit. Second scenario, again deposit at the rate of 18%. So whatever we have written above, broadly the same thing is going to come in. So I'm going to straight away come to the answer. The logic here is, even if you get it today, you will get it 10 lakhs. What could have been done in the third part of the question? What would be the question if JK Limited had raised rather than accepted an invoice? If the company forces the customer to pay it today, it has to give a discount of 1%, early payment discount of 1%. That would make a lot of sense. Then you do 9,90,000 into 0.5 plus interest, vis-a-vis 10 lakh into 0.52, or 9,90,000 into 0.5 plus interest at the rate of 18%. Now next part. If JK Limited was an exporter, Now write below that point number 1. We need to decide whether to receive the payment today, or after the full credit of 90 days. Whether to receive the payment today or after the full credit of 90 days. Next point, it is assumed that the company can collect the money. Assume that the company can collect the money today without giving any discount. Assume that the company can collect the money today without giving any discount. A little illogical assumption, but we'll proceed with because of absence of information. Next, scenario 1, interest rates are 6%. Scenario 1, interest rates are 6%. Below that, in this case we will receive rupees 5,07,500. We will receive rupees 5,07,500 in bracket including interest. We will receive rupees 5,07,500 in bracket including interest. Whatever we have done earlier, I'm just writing the same thing. We will receive rupees 5,07,500 including interest if we receive the payment today. 5,07,500 including interest if we receive the payment today. Full stop. Alternatively, we can receive rupees 5,20,000. We can receive rupees 5,20,000 after 90 days. We can receive rupees 5,20,000 after 90 days. Full stop. The company should go for lagging the receipt. Do the second part. Scenario 2, you just write that you will receive so much including interest. So in this case, we are going to lead the receipt. We'll collect the money today itself. Because if I collect today, I get 522 500 vis-a-vis 5,20,000. Any doubts on this? Yeah. So I receive the money from you today. After receiving, I'll create a bank deposit. For 90-day period. So when I create a bank deposit, bank will pay me interest. So the logic is the interest rates remain the same. That's with that assumption, which is not always the practical world. So they should have ideally given me investment and deposit rates. Yeah. No, so that compounding is basically interest. What is compounding? You pay it today and add interest to it. That interest is nothing but the time value of money. No, so in first case, I pay you 5 lakhs today. After paying 5 lakhs, I take how do I pay 5 lakhs? By taking a bank loan. I did not pay you anything today, so my money is zero outflow. Technically, day 0, it's a zero outflow. I have paid you 5 lakhs. After 3 months, I'll pay 5,07,500 to bank. Vis-a-vis 5,20,000 to you. So both are 90-day amount. See, interest basically does the job of doing the compounding or discounting. Any doubts on this? Can we proceed? Now let's move to question number 2. The following two-way quotes appear in the forex market: spot rate, 2 months forward rate. How many US dollars should a firm sell to get 25 lakhs after 2 months? How many rupees is the firm required to pay to obtain 2 lakhs in the spot market? Assume the firm has USD 69,000. ROI on rupee investment is 10%. Should the firm encash the USD now or 2 months later? Please go through the question. Okay, part 1 and part 2, basics of international finance, known component, unknown component, extend the formula. Part 3 is only on leading and lagging. Let's quickly complete part 1 and part 2. Part 1. The question says, how many USD should a firm sell to get 25 lakhs after 2 months? So known is rupees 25 lakhs INR. Unknown is question mark USD. I don't know how much USD it is going to be, but what I know is 25 lakh rupees. Known is 20. Known means basically what you, which currency amount you know. It doesn't matter whether you are buying or selling. Now formula is USD equal to INR into unknown component equal to known component into, you expand the formula. Unknown is equal to known into expanding the formula. That's part 1 of the calculation, stage 1. What are we doing with the denominator currency, INR? Read it carefully and let me. We are buying, bank is selling, bank will sell it, ask. Please be careful about these aspects. It said how many US dollars should be sold to get 25 lakhs. So we are buying INR, bank is selling. We are buying INR and bank is selling INR. $25 lakhs into 1 by bid rate. $25 lakh into 1 by 47. I'll have to sell 53,191.48 USD to get 25 lakhs after 2 months. Known component, unknown component is equal to known component into expanding the formula. What are we doing with the denominator currency? After finding what are we doing with the denominator currency, whether we have R1 by bid rate. Any doubts on this? Clear? Can we proceed? Any doubts on this? Let's do part 2. How many rupees is the firm required to pay to obtain USD 2 lakhs in the spot market? Part 2. Known USD 2 lakhs. Unknown question mark INR. Unknown is question mark INR. Unknown is equal to known into some expansion of the formula. INR is equal to USD into INR per USD. What are we doing with USD? We are bank selling. So USD into any doubts on 92,50,000? Can you proceed? Any doubts on 9250? Now coming to the third part, assume the firm has USD 69,000 in a current account earning no interest. ROE on rupee investment is 10%. Should the firm encash the USD now or 2 months later? So I have some money in my current account that is not going to earn any interest. If I want, I can convert it today at some rate and earn 10%. If I wait, I can convert it at a higher rate but not earning any interest. So I'll have to compare both. It's a perfect example of your leading the payment, leading the receipt of lagging the receipt. In both the case, you are going to receive only 69,000. You want to receive it today. When I say receive it today, the money is already there with you. You are just deciding when to do the conversion. If you convert today, it will happen at the spot rate, which is 46/46.25. You see which is the right rate to take, or wait and do the conversion, which is 47/47.5. If I do it today, I will earn interest at the rate of 10% per annum. If I don't do it today, I will convert it at a higher rate but earning no interest. Clear? Any doubts on this? Part 3. USD 69,000. USD 69,000. Split it into two. Convert today convert after 2 months. Convert today, convert after 2 months. If you convert today 69,000 into 46 or 46.25? Is it 46 or 46.25? In case you have a doubt, you go through the detailed way of analysis. What I normally keep doing is, if I am going to receive this money, it will be a lower rate, 69,000 into 46. What we receive is always lower, what we pay is always higher. So if it was a payable, it would have been 46.25, because what I receive is always the lower amount. That logic keep always having in your mind, because what happens is, this is a quicker way of resolving your conflict. You will always have an issue whether to take 46 or whether to take 46.25. The simple principle is, if I am going to receive money, I will receive a lower amount. If I am going to make a payment, I will have to make a higher payment. Clear? Any doubts in this? It is, in short, you are selling US dollars and buying INR. Your sale of US dollars, bank is buying, bank will buy at bid rate, into 46 plus interest at 10%. 69,000 into 46 plus interest at 10%. Interest at the rate of 10%. Obviously, you will do it for 2 months calculation. I am not paying. Where did I say interest is paid? Interest is earned on your rupee investment. So you will have to think through the transaction. If you are not thinking through the transaction, then it becomes a little difficult to understand. Basic thing is, you assume that you have a $69,000 in a bank account. If you convert it today, you will go to ICICI Bank and create a FD at the rate of 10%. That's what the question says. ROI on rupee investment is 10%. Rate of interest or return is return on investment is 10%. So you can earn the 10%. Otherwise, you wait for 2 months and convert at the rate of what? Into 47. Here I am not earning interest, but still I am okay with it. 32 lakh, and we are going to prefer encashing 2 months later. The preference is going to be encashing 2 months later. We will do the encashment of this 2 months later. It's okay to not earn interest on US loan or US deposit money, USD, because I'm going to have a better appreciation. There is a better appreciation, so I'm perfectly fine with it. Clear? Any doubts in this? Can we proceed? Go through question 3. Okay, now coming to this question, we have been given two options by my supplier: pay it in 60 days or pay after 90 days. These are the two scenarios they want us to evaluate. If the problem was silent, a third scenario which could have come is pay today. I could have also paid it today. Now, if I pay the supplier in 60 days, I'll have to pay 2 million into the 60-day forward rate and then pay interest at the rate of 10%. Why 10%? Because I'll take an INR loan. Otherwise, I can pay 2 million along with an interest at the rate of 8%. The overseas supplier has offered a 60 days interest free credit, and for additional credit for 30 days an interest of this will be at interest of 8%, and for additional credit period of 30 days at interest rate of 8%. So I have two options: leave the USD liability as a USD liability, pay interest at the rate of 8%, and then reconvert it at a higher forward rate. Because 90-day forward rate is higher than 60-day forward rate. Vis-a-vis, pay the US supplier in 60 days at a lower rate and then pay interest to the bank at the rate of 10%. Clear? Any doubts on this? So the basic thing is, you are just deciding pay the supplier by taking a bank INR loan and interest at the rate of 10%, pay the supplier by leaving it as a USD liability and paying at the interest of 8% and reconvert it at a higher rate. When are you going to do the conversion is what we are seeing now. After 90-day period, I am not bothered about what happens, because in both the scenario you may have to pay interest if you don't have money, or if you have money you make the payment. So I am not bothered about what happens after 90 days. Now let's evaluate this. Center of the page, USD 2 million, USD 20 lakhs, pay in 60 days, pay in 90 days. These are the two scenarios we are trying to evaluate. Should we pay it in 60 days or should we take 90 days period? Now you will have to tell me the steps. I'll keep noting it down. I'm not going to do all this calculation now. You tell me the steps, what is going to happen. See, imagine the flow of transaction. It will be easier for you to understand, because a lot of calculations can be there. Different problem, different scenarios will be there. If you understand the flow of transaction, it will be easier for you to interpret this. If you pay in 60 days, what will be the first thing happen? Convert into INR. Basically, I'm going to pay my supplier by taking an Indian loan. I'm going to pay my supplier by taking an Indian loan. So tell me what amount is that? Pay to supplier. Pay to supplier 20 lakhs into, pay to supplier 20 lakhs into what rate? 57.1. 1142 lakhs. Rupees 1142 lakhs. Now, how this payment was done is by taking a bank loan. You took a bank loan, you went to some bank and took a loan. Now, to this banker, for how many days we have to pay interest? 30 days. Now, I can either do into 30 by 365 or 1 by 12. Broadly, the answer will remain same. Some small approximation differences can be there. Let's do it as 30 by 365 itself. Point number 2, interest. 1142 lakhs into 10% into 30 by 365. Otherwise, what I can do is I can pay my supplier after 90 days, but he is not going to agree on 20 lakhs. He will not agree on 20 lakhs. He will say you have to pay interest at the rate of 8%. So, pay to supplier $20 lakhs plus 20 lakhs into 8% into 30 by 365. If you are doing 1 by 12, do 1 by 12 at both the places. If you are doing 30 by 365, do 30 by 365 into 8% into 30 by 365. The overall amount is 20 lakh 13,000.68. This is the amount we have to pay, 150.68, 20 lakh 13,150.68 into what rate? 57.5. $1157.56 lakhs. This is a simple analysis we are doing, whether to make the payment today or whether to wait and make the payment. If I make the, whether to make the payment in 60 days vis-a-vis 90 days. A hidden alternative in this question is making the payment in 0 days. I can also make the payment today, where it would have been 20, what you have done here, exactly the same thing will happen. 20 lakhs into 56.5, add interest for 90 days. You are going to add interest for 90 days, which is kind of an hidden adjustment. Go through question 4 and start doing it. Go through 4 and start doing it. Let me know in case there are doubts here. Yeah, any number you have a doubt, please let me know. 48 point. I am making the payment. When I make the payment, I have to make a higher payment. An Indian importer has to settle an import bill. You can do known, unknown and do the analysis, but simple logic is when I have to pay, I will have to pay a higher rate. In this question, this is your known, unknown is INR, so it will become INR is equal to USD into INR per USD. You have to pay, which means you have to buy dollars. Bank has to sell dollars, ask rate. I don't get into this detail analysis. If it's a very simple problem like this, simple thing is, see, once you know whether it is division or multiplication, in order to decide whether the first rate or the second rate to be used, whether the bid or the ask rate to be used, the only logic which I use is, if I have to pay, I have to pay a higher amount. If I have to receive, I have to receive a lower amount. That is the only logic I have. If you are clear on division multiplication, if both the points are not clear, then the detail way only. $64 lakh. So it's better to lag the payment. We'll lag the payment and then make the payment afterwards. All of this, the basis remain the same thing, known component, unknown component. Only extra add-ons will keep happening. In currency invoicing, we added few things. Here we have added few things. It's entirely going to come from the basics of international finance. That chapter is the most critical one. Whatever you do there, it kind of used everywhere. No, that's enough. It also depends. For example, if this question is asked for 8 marks, then maybe I'll have to present it a little better and do a detailed calculation. If they're asking for 4 marks, whatever I've done is more than enough. I'm not going to show them calculation, all of that, why a bid rate, why a ask rate, all of that is not going to be shown by me. If it's an 8 mark question, maybe I present it a little better and I give a little bit of more analysis, that's all. Net the answer remains the same. It depends on how many marks they are awarding to the question. Okay, let's move to question 5 now. Any doubts on question 4? Okay. Sun Limited is planning to import equipment from Japan at a cost of 3,400 lakh yen. The company may avail loans at 18% per annum with quarterly rest, with which it can import the equipment. Now quarterly rest means quarterly compounding. So it is going to be 4.5% for the first quarter on the principal. Second quarter or the third quarter, whatever the question talks about, it's going to be on interest as well as principal. So it's a quarterly compounding, which is what is going to happen in this question. Quarterly rest means quarterly compounding. The company has also an offer from Osaka branch of an Indian based bank extending credit of 180 days at 2% per annum against opening of an it is irrevocable, it's not irrecoverable, it is irrevocable letter of credit. Additional information: present exchange rate, 180 days forward rate, commission charges for letter of credit at 2%, 12 month, 2% per 12 months. Advise the company whether the offer from foreign branch should be accepted. Now I'll first explain the question in detail. I have to buy an equipment of 3,400 lakh yen. If I want, I can make the payment today itself. How will I make the payment today? Is by taking an INR loan. Any interest rate? Okay, INR interest rate is 18% per annum with quarterly compounding. So on that 3,400 lakh yen, I'll pay interest at the rate of 4.5% for the first quarter. On the compounded amount, that is interest as well as principal, another 4.5% for the second quarter. The question talks about 180 days. So whether I can pay it today or I pay it after 180 days. How can I pay it after 180 days? Is there is a foreign branch of an Indian bank which is ready to give me a credit of 180 days. It will give me a credit of 180 days at 2% per annum against opening of an irrevocable letter of credit. Now, letter of credit is an instrument which is extensively used in forex markets. So, if I am selling some goods to an US customer, I don't know his credentials, or I am a little worried about whether he will make the payment or not. But he is saying, nothing doing, I need a credit of 180 days. Otherwise, I am not going to deal with you. So, I am okay giving a credit of 180 days, but how it will happen is, I will give a credit of 180 days, but he has to give me a letter of credit against it. What does an LC do is, after 180 days, whether US customer pays me or not, whoever has extended that letter of credit, he has to make me the payment. So, that letter of credit will ensure that I receive the money, whether my customer pays it or the bank pays it, because bank has guaranteed that. So, because bank guarantees it, bank is not going to give a free guarantee. Bank will charge a commission at the rate of 2% for 12 months. So, either I pay it today, or what is going to happen is, I'll go to my bank ICICI and say that give me a letter of credit. This is what has happened in the Nirav Modi case, that it was called as letter of comfort. It was called as letter of comfort, broadly serving the same purpose. So, in a letter of comfort, the guarantees keep getting extended. Letter of credit is closed by one transaction to other transaction, it gets closed. So, what happens here is, I'll give the letter of credit to my supplier. This supplier will give me a credit, but supplier is not ready to give me a credit. So, some bank is giving me a credit, but bank also wants me to give this LC. So, the transactions will be like this. Go to ICICI, get LC. ICICI will charge me a commission. Give this LC to Standard Chartered. Which Standard Chartered? There is a Japanese Standard Chartered branch which is staying there. So, I give this LC to Standard Chartered. Stancy is very happy to give me credit now, because they think ICICI, it's like ICICI bank taking a loan the moment I give a letter of credit. So, they are okay to give me a credit. So, they give me a 180 days credit at what rate? 2%. So, now it's like this. If you pay it today, very simple, pay it today, pay interest and closed. If you pay it after 180 days, first you have to pay commission. On day 0, I have to pay commission to ICICI bank, because ICICI bank will give me this LC by after taking commission. Second thing, after 180 days, I am not going to return 3,400 lakhs. On 3,400 lakhs, I'll have to pay some interest. That interest is at the rate of 2%, insignificant interest, but I have to pay that interest at the rate of 2%, and then I settle as liability. Clear? Here I take the loan, pay interest for 180 days. There I take the loan, pay interest at the rate of 2%. Clear? Any doubts on this? Now, right, option 1, making the payment today. Option 1, making the payment today. Making the payment today. In that point number 1, the company has to make a payment of 3,400 lakh yen The company has to make a payment of 3,400 lakh yen today. 3,400 lakh yen today by taking a bank loan. 3,400 lakh yen today by taking a bank loan. By taking a bank loan. Next point. Payment made today in bracket loan taken. Payment made today in bracket loan taken equal to. Look at the spot rates and tell me what it will be. Into what by what? Payment made today in bracket loan taken. 3,400 into. Look at the spot rates and tell me what should I do. Into 100 by 340 or 340 by 100? Think about it and let me know. If 100 is creating a confusion to you, you make it as rupees 1 is equal to 3.4 yen. That's all. If you have been used to rupees 1, then it's rupees 1. So should I divide by 3.4 or multiply by 3.4? Divide by 3.4 or multiply? Divide by 3.4. Clear? Any doubts on this? It's divide by 3.4. So I'll write into 100 by 340. Into 100 by 340. So this is rupees 1,000 lakhs. Rupees 1,000 lakhs. 3,400 into 100 by 340. On this, now I have to pay interest at the rate of what? 18%. Now please listen, 18% can't be into 18% into 180 by 360. It will be into 4.5% plus original 1,000 plus into whatever 4.5% you get, on that another 4.5%. It's kind of compounding. So now listen, payment after 180 days is equal to 1,000 lakhs into 1.045 into 1.045. When you do into 1.045, another into 1.045, you have charged interest on interest. If it was not quarterly compounding, then it would have become into 1.09. That is only 9% interest. You would have multiplied with 1.09. It's quarterly compounding. Quarterly rest means quarterly compounding. So 1,000 lakhs into 1.045 into 1.045 into 1.045 takes it to 3-month period. When you do into 1.045, you will get 1,045 lakhs. What is that 1,045? 45 is interest, 1,000 is the principal. Now for the next 90 days, the principal itself is 1,045. That's why into another 1.045. Rupees 1,092.03 lakhs. If that quarterly was not there, it would have become 1,090 lakhs. It would have become 1,090 lakhs, which is 9% interest. Any doubts on this? Clear? Can we proceed? Any doubts on this? Next. Pay after 180 days. Pay after 180 days. Now write point number 1. The company can get the company can get a credit of 180 days, by opening an LC, Next point, LC has to be opened today. LC has to be opened today by paying a commission. LC has to be opened today by paying a commission. Next, commission to LC issuing bank equal to, commission to LC issuing bank equal to 3,400 yen into 100 by 340. I'm converting into INR. 3,400 yen into 100 by 340 into 1%. Why 1%? 2% is for 12 months. 2% is the commission for 12 months. So into 1%. How much is the commission? 10 lakhs, no? 1,000 lakhs it was. It will be 10 lakhs. Any doubts on the LC commission? Okay, now please listen. The moment I paid this LC commission, I'll now have only one payable after 6 months. Finance doesn't allow you to add a 6-month outflow with a month zero outflow. So indirectly what the question's assumption was that you took a bank loan to pay this 10 lakhs. So on this 10 lakhs you'll have to charge some interest. On this 10 lakhs also you'll have to charge some interest. See, as a basic rule, you cannot add a month 0 cash flow with a month 3 cash flow or with a month 6 cash flow. So certain problem institute has conveniently ignored it. That's their answer. But wherever we are ignoring interest, I'll have to write a assumption on it. Now the assumption what institute has taken in this question is, you are paying this 10 lakhs. How are you paying it? By taking a bank loan. Or if you have your own money, then charge opportunity cost. If you have your own money, charge opportunity cost. If you don't have your own money, take a bank loan. Either ways, I'll have to add interest to it, because 10 lakhs can't be added with what you pay after 6 months. So I'm going to now calculate amount payable after 6 months. But this amount payable after 6 months can't be added with a month 0 outflow. Finance doesn't allow you to add month 0 outflow with a month 6 outflow. They cannot be added. That's what we learnt in time value of money at IPCC level. So your month 0 cash flow cannot be added with month 6 cash flow. To make them addable, you will have to do a conversion. Then only you can add it. Clear? Any doubts to this? Next point. The company has to pay 3,400 lakh yen. The company has to pay 3,400 lakh yen. 3,400 lakh yen after 6 months. After 6 months, along with interest of 2%. Along with interest of 2%. So now write payment equal to payment equal to 3,400 lakhs. I'm adding 1% to it because 2% is what? Per annum? Yeah, 2% is per annum. 3,400 lakhs plus 1% into what is the forward rate? Into 100 by 345. 985.51 lakhs. 985.51 lakhs. 3,400, sorry. It is 995.36 lakhs. So I'll have to pay 995.36 to this foreign branch which is there. 995.36 lakhs. In short, he wants 3434 lakh yen. Any doubts on this? Now listen. Total outflow is, listen, LC commission plus interest on LC commission plus supplier payment. LC commission, interest on LC commission plus supplier payment. LC commission is 10 lakhs. Interest on LC commission is 10 into 4.5%, 0.45, listen for some time, plus 10.45, interest on interest, 10.45 into 4.5 percentage, which is 0.47. In short, it is 10 into 1.045 into 1.045 plus 995.36. Overall, this is the amount which I have to pay. I'll have to pay LC commission today. That 10 lakhs and 995 are not addable. You cannot add them. How do I then add it? You can add it post doing a conversion. So post doing a conversion or you can add them post converting them to the 6-month period by doing a technique called as compounding. When you charge interest, it compounds. When you discount interest, it comes to the present value. Any doubts on this? Which is beneficial? Making payment after 180 days. So basically we can accept. The question said whether the offer from the foreign branch should be accepted. Yes, we should go ahead with the offer from the foreign branch. Earlier, your wish, that doesn't matter. LC is closed, that's all. You close an LC. If you don't close an LC, it calls devolvement of LC. It devolves and the banker has to make the payment, and banker will charge you some charges. So that LOU which they were indicating in that buyer's credit wala part, what they were saying is letter of credit will have a one-to-one mapping. Every transaction there will be a one-to-one mapping and there will be a closure of a letter of credit. In case of a letter of comfort, that one-to-one mapping was not there. So within the system, they were not able to track how much LOUs were issued by the bank. So there is no concept of a one-to-one mapping or a closure of an LC. That's the difference which I could understand when I did a little bit of analysis. But as such, practically both more or less serve the same purpose. LC and this both serve more or less the same purpose. LC is mostly used when you have a base transaction in place. You will at least have a base transaction in place. In case of letter of undertaking or letter of comfort, that base transaction may not be even known. So in this case, there will be a base transaction, either I am buying the goods or selling the goods. So one-to-one tracking is there, and then the closure of an LC happens. So practically it's not always you need a 100% FD. So you have come to a practical aspect. So what happens is every bank will give its customer a letter of credit limit, LC limit. So when an LC limit is given, if I give you a 10 crore LC limit, against that you would have to give me a collateral which will be 10% FD. That's technically called as a cash margin. That 10% FD you will have to consider the notional interest cost, whatever. So from a problem point of view, you may not have. When a customer takes more than 10 crore limit, bank will give you only against a 100% FD limit. So that's what you are indicating about. Obviously the interest which you lose has to be taken as an opportunity cost. Now technically there is one mistake with this question. Your exchange rates are not right. 100 equal to 340. 100 can't become 345, it should have ideally come to 320 or 316 or 325 because Japanese interest rates are lower. The interest rates in Japan are lower. Ideally, yen should appreciate. In this question, yen has depreciated. The exchange rates given in the question leads to depreciation of yen. That is why you see a huge difference in the answer also. 1092 vis-a-vis 1006. Why this huge difference is there? One, my liability depreciates because yen is my liability and liability depreciates. On top of that, I am paying a lower interest. So double advantage for me. Ideally, when I am paying a lower interest, yen should have appreciated. Ideally, yen should have appreciated. In this case, instead of an appreciation, yen has depreciated. So that is logically speaking, it should have been 100 by 320 or 325 here. If that had happened, this 995 would have become something like 1050 or so. Then both answer would have been more comparable. Here your yen is depreciating. On top of that, you give me a lower interest rate. I need not do any calculation. Without doing a calculation itself, broadly I know the answer. Unless the LC commission was very high. At least the LC commission should have been high. Somewhere I should have paid a higher amount. Nowhere I am paying a substantial amount. So indirectly I know final answer is going to be acceptance of a foreign branch. The calculation anyway has to be shown. Clear? Any doubts on this? Okay. I'll move to the next technique now, which is netting. Now coming to netting, what does netting say is that practically this is what we adopt at least. If I have to pay you 10 lakhs and you have to give me 5 lakhs, normally nobody is going to pay 10 and 5, you net off the amount and pay the amount. Now why netting can help in reducing my forex risk is if I am dealing with a customer who is also my supplier. At times he can also be my supplier. How it happens is he will give me some raw material, I'll work on it and then give it back as FG to him. So when I do that, I have to pay him some amount, he also needs to pay me some amount. Now this technically there are two terms, one is called as job work and second is called as total production. If it's a job work, then he gives me the raw material and when I give him the product, I'll charge only something called as conversion charges. So there is no purchase, there is no sale, only conversion charges are there. In that case, no netting is going to come into picture. But netting can come when I have a payable. Payable is for the raw material, 10 lakh USD. Receivable, 15 lakh USD. With the same customer, it's with the same customer, then you have something called as a Then you'll have something called as netting of transaction, paying 10 lakhs and receiving 15 lakhs. Clear? Now, practically it's not going to be with the same customer. I will have a payable as well as a receivable in 90% of the transaction. So when a company has more of exports and imports, when I receive dollars, I will not convert the dollars into INR itself. When I receive some dollars, I will not do the conversion itself. I'll keep it as dollars and pay it back as dollars to my customer, to my supplier. So what ideally companies will do is they'll receive dollars, keep it as dollars and pay the dollars to my supplier. So supplier, customer, two parts to the transaction. Receive dollars. There's an account called as EEFC account, Exchange Earners Foreign Currency account. There the money will lie and you pay that amount to the other person. So rather than doing the conversion, in conversion I lose bid and ask difference. That's only my problem. Whenever I do a conversion, I lose the bid and ask difference, because when I convert dollars, he'll convert at 65. When I reconvert, he'll say I'll divide by 66. In this process, I lose money. So instead of doing the conversion, I will try to do a netting of my transaction. This is one practical aspect of netting. Second practical aspect can be there if there are a lot of companies within the group. Within the group, if there are a lot of companies, company 1, company 2, company 3, company 4, company 1 has to make payment to 2, 3, 4, receive payment from 5, 6, 7, like that there can be multiple companies. Finally, what the head office can do is, it will do all the transactions, compare all the transactions and then finally say, company 1 need not make the payment to 2, 3, 4, it can receive only from company 7 so much, company 6 will make a payment to company 2. So, kind of netting of the transactions within the group. So, there can be a multilateral netting and bilateral netting. Bilateral means two parties only. Multilateral is more than two parties. More than two parties can happen only within the group. Practically, I cannot do a multilateral. That is, you have to give me a payment and I have to give a payment to one other person. I cannot tell you that don't give me the money, you give money directly to the other person, because you are not going to agree, he is also not going to agree, and I also wouldn't want this to happen, because by doing this, I am giving the information to you as to who are my customers, who are to my suppliers. Those information I wouldn't want to give. So bilateral netting can happen. Within us, we can do a netting. Multilateral, more than two parties, cannot happen outside the group. Company A has to pay to company B and receive from company C. Company C and B are not known to each other. So I cannot tell company C, why don't you make the payment directly to company B? That's not going to happen. So I will act as an intermediary, but the only thing is I will not do the conversion, because conversion will lead to loss of your bid and ask difference. So instead of doing conversion, make the payment directly. Clear? Any doubts on this? Okay, let's do this question 1. Just go through this question, I'll come in a minute. Okay, now coming to this question, we have three subsidiaries, which is Belgium, France and USA. Now one subsidiary has to pay to the other subsidiary, so we'll have to kind of convert all these transactions into a single currency, because they are in multiple currencies, we cannot understand them. The common currency given in this question is what? Pound sterling, which is GBP. You will have to convert all of this into GBP. After converting all of this into GBP, they can become addable. You can add them, deduct them. So let's write particulars in 3 columns. Particulars and 3 subsidiaries. Belgium, France and USA. Belgium, France and USA. Belgium, France and USA. All the transactions given in the question will be converted into GBP. Then only they will become addable. First thing, French subsidiary to Belgium. We are just noting down whatever it is. I'll explain how you do the netting in some time. French subsidiary to Belgium. This 144,381,000 I'll have to convert into pound sterling. What should I do? 144,381,000 I have to convert into pound sterling. Divide or multiplication? Divide by 68.10. Divide or multiplication? Everyone's participation. Divide or multiplication? Divide. So divide by 68.10. Now listen for a minute. 144,381,000 divide by 68.10. Now what I'm going to do is, I'm going to write this as a positive item in French subsidiary. Positive means receivable, and the same amount will become a negative item in Belgian subsidiary. Net it will add up to 0 only. Positive for French, negative for Belgian. Okay, so French to pay. So French has to pay. So negative for French and positive for Belgian. Whoever has to receive, it's a positive item for them. Whoever has to pay, it's a negative item for them. Net finally, if the total is negative, they have to make a payment. If the total is positive, they will receive a payment. Any doubts on this? First, I divide by 68.10. Now listen. In the France, it's going to come minus this amount. Minus 2120,132. For Belgian, plus this amount. 2120,132. You can have 2 decimals maybe. French to pay Belgian. So French negative, Belgian positive. French is negative, Belgian is positive. The second one is Belgian to US. Belgian to US. How much is the amount? USD 1060,700. Divide multiplication. Everyone's participation. Divide multiplication. Everything is going to be divide only because it's per pound everything. So 1060,700 divide by 1.415. Divide by 1.415. Which one positive, which one negative? US positive, Belgian negative. USA positive, Belgian negative. I'm converting everything into pound sterling. Payable is written as negative, receivable is written as positive item. Next one, US to French. US to French subsidiary 14,438,000. 14,438,000 divided by what? 1.3834. US to French divide by 1.3834. Positive for which country? France is positive, USA is negative. France is positive, USA is negative. Say if it was a single currency, it would have been easier for us to do. It's multiple currency, so we are first doing the conversion and then writing positive, negative, that's all. Last one, France to US. French to US. French to US is $8 lakh divided by what? 1.415. Clear? Any doubts till now? Now just put a total of this. We can have n number of transactions, it doesn't matter. I'll have to convert everything into same currency. Put a total of this. All of this is in GBP. Any doubts on this? Now instead of making all these 4 payments, I'm just going to tell the head office is going to give instructions to these subsidiary. The instruction will be that US subsidiary has to pay 13,70,520 pounds to Belgium, 77,51,102 pounds to France. That's all. It ends there. France and Belgium is not going to pay among themselves, between themselves, anything. US has to pay 13,70,520 and 77,51,102. That is nothing but the total adds up to 91,21,623. It's not that they are paying extra amount and all. The overall total, every row if you put a overall total, it's going to be 0 only. That's how we have made the transaction. So net, the netting says that US subsidiary has to pay 13,70,520.85 GBP to Belgian and 77,51,102.28 GBP to France subsidiary. Clear? Any doubts on this? So now that is the conclusion. That's a single payment which has to be made. US subsidiary has to pay 13,70,520.85. 13,70,520.85 GBP and 77,51,102.28 GBP to Belgian and French subsidiary respectively. To Belgian and French subsidiary respectively. Done? Any doubts on this? So all those 4 transactions which were given, we have converted into a single transaction and told them, now this reduces the forex risk for all the people. It is now only GBP risk for them. From an overall group point of view, there is no risk because entirely in GBP. Any doubts on this? Let's move to question number 2. AMK Limited, an Indian-based company, has subsidiaries in US and UK. Surplus funds for the next 30 days from 2 subsidiaries are as below. Exchange rate information is obtained. Annual borrowing or deposit rates simple are available. The Indian operation is forecasting a deficit of 500 million. Interest rates are based on a year of 360 days. Calculate the cash balance at the end of 30-day period in INR, 30-day period in INR for each company under each of the following 2 scenarios. Each company invests or finances its own cash balance in local currency. Cash balances are pooled immediately in India and the net balances are invested. Which method do you think is preferable from parent company's point of view? Please go through. Okay, now in this question, how netting is going to be useful is, both the subsidiaries are having a surplus cash. Now the company wants to decide whether to invest the money in their own country, that is without doing any netting off on day 0. That is, US invests its own money, UK invests its own money, and Indian based company take its own loan because it is forecasting a deficit. For a deficit, it has to take a loan. So 2 companies will make investment at the deposit rate and 1 company will take a borrowing At the end of 30 days, they want the final answer in INR, so we'll do the conversion and then get the figure. That is one way of investing, which is called as decentralized cash management. The second one is centralized cash management, which is taking the surplus from US and UK to India and see whatever is the surplus finally there and invest or borrow that in India. So option one is each company invests its own cash balances in local currency independently. Second is everything is pooled in India and India does the investment. So in scenario one, what will happen is UK will do the investment, earn interest on it, and at the end of 30 days, you will convert into INR. US will do the investment, earn interest on it, and will finally do the conversion. Second scenario, US and UK, we will first do the conversion, see whether there is a surplus or deficit, and then deposit or borrow that amount and find out. So first scenario one is invest and then convert. Scenario two is convert and then invest. That is what it's all about. So you'll have to first do the conversion and then think about investment. Working note one, calculation of cash balance. If the funds are managed independently. If the funds are managed independently. I may require some 7-8 columns, so we'll keep opening the columns as and when it is needed. First one is entity. Entity. Manage space accordingly, you may require some 7-8 columns. Entity. There are 3 entities in this question. One is the parent company, which is India based company, and you have a US subsidiary and UK subsidiary. So in entity you can write US subsidiary, UK subsidiary and parent. US subsidiary, UK subsidiary and parent. Now second is surplus slash deficit. Surplus slash deficit. Surplus slash deficit. Deficit means I'll put in brackets. Surplus means I'll leave it as it is. What is the surplus of US subsidiary? 12.5 million. We'll write it with currency. 12.5 million USD. 12.5 million USD. UK subsidiary 6 million GBP. 6 million GBP. Parent in brackets INR 500 million. Clear? Now every entity is going to do investment or borrowing at their own country level. Nobody is going to come to India. The funds will lay with them and they will do the investment or borrowing. Next column, investment slash borrowing rate. Investment slash borrowing rate. At what rate US will invest? How much? 1.5%. UK 3.7%. India will borrow at the rate of 6.4%. Any doubts on this? Everybody will do their borrowing or investment. Next, interest for 30 days. It's basically 30 by 360 in this question, so you can do into 1 by 12 itself. $12.5 into 1.5% into 1 by 12. I left it as million itself and done the calculation. If you convert into normal rupees and do, or normal numbers and do, that's also fine. Any doubts on this? Clear? Next, cash balance after 30 days. Add the interest and write it. $12.515625 million, 6.0185 million, 502.666667 million. One is in USD, second one is in GBP, third one is in INR. You have in USD, you have in GBP, you have in INR. Any doubts on this? Now all of this has to be converted into INR. Finally, I want the balance in INR. So you can do that conversion using these rates. Which rate to use? You think about it and then do. Okay, sorry, there's only single rate. Yeah, whether division or multiplication, you just check and do it. 0.0217, 0.0150, division, multiplication after the 30-day rate. We will take it. No, I didn't understand. Last column is conversion. Yeah. This is cash balance again in bracket INR. Everything you are converting into INR. Finally made it into two decimal numbers. You will have to do the division. I hope you are clear on that. You will have to divide and get the values. I have rounded off at 2 decimal level. Earlier I didn't because USD impact will be higher. So earlier we didn't do. Finally, after converting it to INR, we have done the rounding off. $475.32 million. This is the amount we are going to have after 30 days. Two entities will have surplus. Indian entity is going to have a deficit. Overall, it is 475.32 million. If you do an independent management, this is what the balance is going to be. Can we proceed? Any doubts on this? Next, working note 2, calculation of cash balance if the funds are pooled immediately in India. Okay, we may require I think 6-7 columns again. Entity, first two are same, entity and surplus, you can just copy paste. Entity and surplus or deficit is same. Entity, surplus slash deficit. Okay, now please listen. In the second part, what we are going to do is we are going to first convert them into INR and then only do the investment. There earlier what we did is we did the investment or borrowing and later on converted. So now what is going to happen is I will again write surplus slash deficit in INR, and moment I do this, I'll put a total and thereafter the individual entities lose its relevance. There is no separate entity called as US, UK or India. It's only total. Total will tell you whether you invest or borrow, and total will tell you the final balance. So we'll first do the conversion now and put a total immediately. So do the conversion. 12.5 divided by any doubts on 484.08 million? We don't have a separate entity now. Everything is one entity and the combined balance is 484.08 million. Any doubts on 484.08 million? After getting this, I'm going to do investment. No borrowing, investment rate. We are going to invest this balance. In India, at what rate we are going to invest? 6.2%. Investment rate 6.2%. I don't have a separate calculation. No individual entities exist. It's only one entity. There is only single entity which exists. Balance after 30 days. Add interest and tell me after 30 days how much it is. INR 486.58 million. 6.2% interest for 30 days. We'll get INR 486.58 million. So I can do the netting of transaction. Netting is converting all the liabilities into one liability or surplus into one transaction on day 0, or do it after 30 days. INR 486.58 million is the answer. Any doubts on this? So which is better from a parent company point of view? Pooling the funds immediately. You will have to pool the funds immediately. That's the part 2 of the question. Which method do you think is preferable? So you can write that. The company should go for pooling of cash balances immediately. Any doubts on this? We'll move to question number 3 then. ABC Limited of London is committed to the following transactions: make interest payment of USD 200, receive 200 euros, receive USD 200, make 200 euros. Spot rates are given, other foreign exchange and interest rates are available. 90-day forward euro rate, 180-day forward euro rate, 90-day interest rate, 180-day interest rate, 90-day GBP rate, 180-day GBP rate. Demonstrate how the UK company can achieve certainty of value for its future payables and receivables. Please go through the question. Okay, now coming to this question, they have given details of a company which is to do 4 transactions. Make interest payment of USD 200, receive USD 200 in 180 days. This and this will get knocked off against each other. Make interest payment of USD 200 in 180 days, receive USD 200 in 180 days for a sale made to USA manufacturer. So that kind of gets netted off against each other. The problem is with these two, receiving in how many days? 180 days, and making payment in 90 days. So I cannot net off against these 2 transactions, can't be net off against each other. Now they basically want us to say, demonstrate how the UK company can achieve certainty of value for its future payables and receivables. Certainty means today you should tell me how much are we going to pay in terms of GBP. Today I want the net amount. Don't tell me to wait for so much period and then finally tell the exchange rate has gone up, exchange rate has come down. That is not going to work out. Now, this is technically part of money market hedge, but anyway, I'll explain it now. Now, these 2 transactions will get netted off against each other. Now, what are we going to do for this is 180 day and a 90 day. One way of ensuring certainty is taking a forward cover. The moment you take a forward cover, you kind of have ensured that there is a certainty of payment which is going to happen? You will make the payment in 90 days, you will make the payment in make the payment or receive the payment in 180 days, whatever be the scenario. The other part which I can do is 90-day interest rate for euro and 180-day interest rate for euro. What we can do is we can create a deposit as well as take a loan today. Why will I create a deposit? I will create a deposit in such a way that it matures to 200 euros in 90 days. It matures to 200 euros in 90 days. When it matures to 200 euros in 90 days, what is going to happen is I will take that 200 euros and give the payment to the supplier. Give the payment to the supplier. Today I will create a deposit. So certainty will be there. How much GBP I have to pay? Today the certain amount will be there. The second option is, that is one option for making payment of 200 euros. And you also are going to receive 200 euros in 180 days. For this part, what we are going to do is, we will take a loan today. We'll take a loan today. I'll explain this as I go to the steps. Technically, this is part of money market hedge. Now, let me first knock off those two transactions and then we come to this. Now, right, the company has to make a interest payment of USD 200. Has to make an interest payment of USD 200 in 180 days. Interest payment of USD 200 in 180 days. Full stop. It is also expected to receive. It is also expected to receive USD 200 from a customer. It is also expected to receive USD 200 from a customer. Full stop. These two transactions will be netted off against each other. These two transactions will be netted off against each other. When I say net off, I will receive the money and make the payment. Will be netted off against each other. Next point. The company is expected to receive, the company is required to pay 200 euros is expected to pay 200 euros in 90 days and will receive 200 euros in 180 days. Will receive 200 euros in 180 days. Full stop. These transactions cannot be netted off. Cannot be netted off as there is a difference in timing. Cannot be netted off as there is a difference in timing. Okay. Now I'll take you through how are we going to hedge it. I have to pay euros or USD, which one is to be paid? Euro 200 in 90 days and euro 200 in 180 days. Euro 200 in 90 days and euro 200 in 180 days. These are the two transactions which I have to hedge. Now I can hedge it by taking a euro deposit, by also doing a GBP deposit. First is euro, which is easier to understand. Now euro 200 is needed in 90 days. What is the 90-day interest rate for euro? 9.5. Okay, so deposit to be created today. Why do I create a deposit? So that I get 200 euros after 90 days. I need 200 euros. Deposit to be created today is 200 divided by 1 plus, what is the interest rate they have said? 9.5% divided by 4. Basically, I'm adding only the 3 months interest rate. Let it be 3 months. 90 days is 3 months. Can you tell me this amount? I'll tell you to note down. Listen for some time. 200 divided by 1 plus 9.5% by 4. 1. Deposit to be created today is 195.36 euros. I need to create a deposit of 195.36 euros. Somewhere I'll have to take a loan and pay it, or I have to take my own money and do it. I also know that I'm going to receive how much euro? 200 in 180 days. Against this, I'll take a loan. See, against a liability, I am creating an asset. Against an asset, I am creating a liability. What I can do is, I will go to the bank and say, somebody is going to pay me euro 200 in 180 days. Why don't you give me a loan against it? So he is ready to give me a loan. He says 180 day interest rate is how much? How much? 8.25. So he is ready to give me a loan, and the loan which I am going to take is 200 divided by 1 plus 8.25% divided by 2. 180 day interest rate. 1. So I was needing 195.36 euros to create a deposit. This is my, nobody is going to, no bank is going to say, why are you creating a deposit? So I wanted to create 195. I didn't have money for it, so I have already taken a loan. Loan is how much? 192.08. All of this happened today, okay? So I still need, requirement is 195.36 minus 192.08. This is my net requirement. How much? 3.28 euros, and I am going to give this today by converting at the spot rate. What is the spot rate? What is the spot rate euro per GBP? 1.6. 3.28 divided by 1.6 is how much? 2.0. Okay, 2.052. I hope you are clear on division, or otherwise you go through known and unknown component and do it. Net, I am going to pay GBP 2.05 rupees, sorry, GBP 2.05 today, and ensure all the transactions are edged. The certainty is there. The certain amount is GBP 2.05. With GBP 2.05, I have covered all the transaction. US transaction got netted off against US transaction. Euro transaction, if not for the timing difference, I would have had a zero outflow only. Why I am having an outflow? Technically, this GBP 2.05 is like an interest for 90 days. Why interest for 90 days? Because you receive 200 euros on day 90, and you have to pay 200, sorry, pay 200 euros on 90 days, and you will receive it only in 180 days. So technically, for that 90 day difference, indirectly we are paying interest. How that indirect amount has been calculated is, I was to receive 200 euros in 180 days. Against that, I go to bank. How the transaction will flow is, first I will go to the bank, say that there is a 200 euro receivable for me. Why don't you give me a loan against it? He says my interest rate is 8.25%. Reverse working, I'll give you a loan of 192.08 euros. When your money comes, you can pay me 200 euros. I say perfectly done. I take this 192. I go to the other bank to create a deposit. When I have to create a deposit, I feel that I need 195.36. Why do I need 195.36? Because of the interest part which is there. So I need 195.36. 200 euros is what is to be paid. I reverse work, got 195.36. I already have this amount, so I feel that I need only 3.28 euros. So I needed 195, have in hand 192, need another 3.28 euros. So the CFO feels that let's buy this 3.28 euros through GBP. So you buy it through 2.05 GBP. Your certainty of outflow is 2.05 GBP. Now all this transaction will be done in GBP in some time, but your certainty of outflow is 2.05 GBP. Any doubts on this? Any doubts on why division? This is technically called as money market hedge. I'll come to money market hedge in some time, but it's technically like a money market hedge. Any doubts on this? So write this now. Euro 200 in 90 days. Certainty means nothing should change. Logically, what you do should happen practically, but you don't know what is the interest rate. Certainty would mean you'll have to guarantee saying that this will be the amount. Net GBP 2.05 will be the outflow on day 0. That ensures certainty of payment. GBP 2.05. So an easy way of doing this transaction could have been that on 90th day I take a 200 euro loan. That could have been an easier way to pay the 200 euros. I take a loan on the 90th day, but we are not taking that into consideration because we don't know what interest rate will be there after 90 days. Certainty means you have to tell me with guarantee that this is the outflow. That is called a certainty. Interest rates after 90 days can be anything. So that is something which is beyond our control. So you are not giving a certainty. So certainty would ensure, or you will have to tell me with 100% guarantee that it is GBP 2.05. That certainty can be done only through this route. Any doubts on this? Now the same part I can do it through GBP loans. Any doubts on this? technically called as money market hedge. There you will learn it in detail, but here we have just got used to a little bit of it. Any doubts? Some of you look a little confused, so if there is a doubt, let me know about it. If at all there is a doubt, can we proceed? Okay, now the same thing what we are going to do is euro 200, listen for some time, in 90 days. Euro 200 in 180 days. Now this euro 200 in 90 days will be converted into GBP. You will convert into GBP using the 90-day forward rate. This will also be converted into GBP using a 180-day forward rate. After this, it's no more 200 euros, it is some GBP. Once this is done, take a GBP deposit or create a GBP deposit, take a GBP loan. Create a GBP deposit and take a GBP loan, and you find the certainty, how much is the difference. That is your certain outflow on day 0. Instead of making it as 200 euros and 200 euros, I will convert into GBP now itself. How will I convert into GBP is forward rate, 90-day forward rate and 180-day forward rate, because these are the rates which are going to prevail on that day. So we will convert into GBP. Post doing the conversion to GBP, for a liability create a asset, for an asset create a liability. Clear? Any doubts on this? Next, hedging through GBP route. Hedging through GBP route. Earlier was euro route, now hedging through GBP route. Hedging through GBP route. Two parts. Euro 200 in 90 days. In bracket payable. Euro 200 in 180 days in bracket receivable. First one, put arrow mark down. Convert into GBP. Convert into GBP using 90-day forward rate. Convert into GBP using 90-day forward rate. Convert into GBP using 90-day forward rate. Other side, convert into GBP using 180-day forward rate. $90-day forward rate and 180-day forward rate. Now do this 90-day and 180-day. 2 decimal answer. $121. GBP 122.70, 121.21. 122.70 and 121.21. $122.70, put arrow mark down. Create a GBP deposit. Create a GBP deposit. Other side, take a GBP loan. Same calculation, whatever we have explained earlier. Create a GBP deposit, take a GBP loan. 2.38 ठीक है. Any doubts on this? Now write. Any doubts on 2.38? Now write. The company can achieve certainty of value. The company can achieve certainty of value for its future payables and receivables. For its future payables and receivables. Future payables and receivables by taking an euro loan and creating a euro deposit. Euro loan and euro deposit. By taking a euro loan and euro deposit. Full stop. This will have a net outflow of GBP 2.05. This will have a net outflow of GBP 2.05. Net outflow of GBP 2.05. We have completed 14 years. Bharadwaj has completed today 14 years. Okay, before proceeding to the next area, I'll give the summary now. Go to the last pages. Topic 47. Topic 47, currency invoicing. Topic 47, currency invoicing. Currency invoicing. Point number one, question number one, currency invoicing is one of the techniques, to eliminate forex risk, full stop. In currency invoicing, the exchange risk of the transaction, shifts to the other party. Next point. In this question, the company can get the goods. Built either in dollar or in euros. Next point. The exporter would prefer a currency. exporter would prefer a currency which is expected to appreciate, and hence in this question we will go with euro billing. Question number 2. Importer will prefer a currency which is expected to depreciate. Importer will prefer a currency which is expected to depreciate. Question number 3. Importer will prefer a currency which is expected to depreciate. Again, importer will prefer a currency which is expected to depreciate, full stop. However, in this question both USD and Euro will appreciate. Both USD and Euro will appreciate. And we will consider the currency which is expected to have lower appreciation. Clear? We'll take a break of 30 minutes and then continue.